Today, I wanted to discuss the difference between a development entity and a construction company. A lot of people don't fully understand the difference. So, let's dive into it and how that's going to affect us in accounting. We have a couple of clients right now that are development entities, which are for the same contractor. We just picked up another client, similar situation, development entity, and they are also the contractor. So knowing the differences is going to be very useful in how to categorize certain income and expenses in each of the companies. All right, so a development entity owns the real estate, holds the loan, controls the project economics, and capitalizes project costs into construction in progress. What does that mean? So essentially, we're going to have an entity that's going to be created to hold a property. Most of the time, every project is going to be in its own entity for asset protection purposes. And also, each deal is kind of structured in a different way. Some might be JV, some might be a single owner, some might be the actual general contractor is doing his own spec build. So, a development entity is also going to be the entity that holds the construction loan. As the construction progresses, the development entity is going to be requesting draws from the bank, the lender, and those payments, those draws are then going to be paid to the construction entity. So in the development entity, when they receive that loan proceed, it's going to increase the amount of liability they have on the balance sheet, as well as increase the construction in progress once they pay the general contractor. And a lot of the times that happens simultaneously. So the general contractor is going to report that as income in that set of books, right? You can have a general contractor that is performing multiple projects for multiple developers, or they might even be that contractor's own projects. So there will be a lot of different projects in the book of the general contractor, and every project is going to have its own set of books via the development entity. To kind of a way I like to summarize it that helps me think about it is the developer is the product, or better said, the developer is the books that hold the product that is the household. That is the physical product. That's why all the costs just go to construction in progress until the entity is sold, and then revenue is recognized once the entity is sold. If that developer's intention is to rent, then that asset will be converted to a depreciable asset, right? The construction in progress being an asset will then be converted into a depreciable fixed asset, which that fixed asset will then begin to depreciate the day that property gets into service, which is the day that it is rented. So that's step number one, right? Development, you have a product, which is the house that you're selling. Construction is the actual provider of the service that manages and builds the product. So the general contractor is having expenses of payroll, subcontractors, equipment expenses, supplies and materials that are used for the construction, and anything that is directly related to a construction, that is even timesheets, is always going to be booked as cost of goods sold. So development entity receives loan from a bank, liability increases, pays the general contractor reports that as construction income, and there's work in progress adjustments that is a very similar concept as construction in progress. However, we do recognize the expenses throughout the construction progress, as those adjustments are now adjusting construction income based off of a formula of cost, which we'll get into later in a separate video of how work in progress adjustments are posted in construction entities. Typically the end result for the clients that we will deal with are spec builds. So what is a spec build? A spec build is a developer has a certain product that they've created. They've engineered a certain house. They probably already have a certain formula that's kind of working already, or that they're testing out, right? They're trying to attach their product to the market. At the end of the day, it's you're selling a product when you're selling a house, right? So in a certain market, a 4-bedroom, 2-bathroom may be selling better than a 2-bed, 2-bath, or barn dominium might be a hotter product than just a old concrete block house. So the developer's consistently trying to see where he can make the most amount of money off of a product for that market. When a developer is building a product that he designs, that's considered a spec build. When a client approaches a general contractor for a home that they want to be custom made because they're going to live in, that's called a custom home. So those are two terms in the industry which will normally going to be dealing with the spec building side. Oh, here we go. Wrong slide. All right, so the develop entity books. Cash comes from owner equity, investors, or construction loan draws. Payments to the GC are capitalized as construction in progress. The loan liability usually sits here. Profit is generally recognized when the property is sold or rented. Property begins depreciation only if rented and placed in service, i.e., date rentals begin. The contractor books. Cash received from the developer's construction income. Subcontractors, suppliers, labor and permits are job costs or cost of goods sold. Costs are tagged by job and category. WIP later adjusts timing based on job progress, and that timing is determined by total cost compared to the budget, which I guess I mentioned earlier. We're going to dive into those specifics later when we do a video specific on work in progress adjustments for general contractors. Right now, the goal is just to make sure that our mind is very familiar with the two different types of entities. So when we are looking at the books, we can develop our critical thinking skills better when we're seeing certain transactions to ask better questions. The deals are typically structured in different ways. You have a single owner development. One owner holds a development company and may also own the construction company. The separation of the books is still very important. Even if the ownership is still the same, typically you're not going to have a lot of to-from accounts on this type of relationship, because the development entity will pay for the arch plans, will pay for impact fees, will pay for all the pre-construction costs, and a lot of that has to do with compliance, etc. On their own. And then once the construction actually begins and they retain the general contractor and subcontractors start performing work, that's when the money that goes out is actually going to be considered as construction income into the general contracting entity. The other very common structure is going to be partnership or JV deals. So investors will partner up and contribute equity, and then they'll go ahead and develop. So what we are experiencing a lot is that land is purchased between a joint venture, and that joint venture, or rather, that land has to be paid in cash, and then they will get a construction loan for the construction cost, and that loan will be determined off of what the bank assesses the completed product will be worth via an appraiser that they select. So related party GC model is a very common one, like I mentioned before. That's the owner of the GC may be part of the development himself or the single owner in the development. Intercompany billing must be tracked carefully. So like I mentioned, there's not going to be a lot of intercompany accounts there. There should really be there should never be any intercompany accounts there, because typically the development entity is going to receive the money. They're going to go ahead and pay for what they need to pay for. The initial cash contribution typically pays for land, plans, initial permits, and pre-construction. And then from that point forward, once the construction begins, all the payments are going to the GC to complete the job. So some things to consider, or some questions to ask yourself, is who owns the real estate, right? That's going to be the development entity, not the general contractor. Who holds the loan? That's the development entity, not the general contractor. Who is contracted to build? Obviously, the general contractor is contracted to provide the service of building the product that developer has designed or has retained somebody to design for them. Are entities related by ownership? If they are, the books are still separate. That is only giving us a little bit more of a clue of how to route certain questions that could arise from the financial activity from either of the entities. Are payments coded to the GC coded as CIP in the development entity? Yes, all the payments to the general contractor are going to be coded as construction in progress to the development entity, and in the general contractor, that's going to be considered construction income. Are GC receipts coded as construction income? The GC receipts from the development entities are coded as construction income. There may be some receipts that aren't. I mean, most of them might be refunds that they actually need to be job costed as well if there's any, return on excess material or anything like that. But for the most part, gross deposits are typically construction income. Are GC costs job costed to COGS? Very important. When we're coding transactions in the general contractor entity, one of my requirements is that the invoices are cost coded and approved by the project managers to make sure they're tagged to the correct project, to the correct cost code. And within that cost code, the cost codes have sub items, which they'll be tagging it to make sure the mapping is correct. So 90% of the expenses in the general contractor are going to be mapped to a specific job. There's some very few exclusions, such as general liability insurance and just, a couple of expenses and maybe office expense, some software, very general things. But most general contractors are not going to have a lot of general and administrative expenses. Is WIP needed to adjust timing? So I'm going to just talk for a second on WIP. Work in progress is essentially an adjustment that's made on a monthly basis that compares the general contractor's cost to his budget to determine what percent of the project is complete. So if my project cost $1 million and my general contractor has spent $500,000, he is 50% through the project. Now, the very important thing to note is when we are closing the books at the end of the month, we will be providing general contractors with a estimate versus actual report showing the expenses of each of the items so that they can confirm if a budget adjustment is needed. So for example, let's say I have $100,000 budget in tile. I'm $50,000 through my tile, but I know on the field I'm not 50%. 100% was my estimate, but let's say for whatever reason we decided to go with a different edging because the material wasn't available, and that was a cost that was not going to be passed on to the development entity. In this case is the customer, right? We're not going to go ahead and pass that cost on to it. So let's say it moved the needle by $2,000. So they need to let us know so we can adjust our estimate. That the tile, we always recommend that our contractors carry a very conservative budget with their work in progress. Once a job is finally closed out, the estimate is going to be tied out to the actual construction cost at the end, and that WIP adjustment, you'll see that profit and loss from that job will carry straight over into the profit and loss report with that adjustment. There's a whole bunch of math there. I don't want anyone watching this video right now to get too crazy on, or if you have any questions, that's great, and they'll likely be answered in the work in progress adjustment video. So just a quick recap: development entity, typically one entity per project. The general contractor, revenue by job, cost by job, clean cost of goods sold, accurate, AP, payroll coding, and WIP adjustments when needed. So our responsibility as we're accounting for this entire process is to make sure that the general contractor's estimate versus actual is as accurate as it could possibly be with the information provided and the work in progress. So it is our responsibility to follow up with the general contractor on a close, make sure that he's looking at his budgets and that they're right. We want to make sure that everything on the balance sheet is tied out. I'm going to repeat all the time in a bunch of videos that the balance sheet is our checklist. We want to make sure that intercompany balances, they're going to exist many times, but that they're kept to a minimum, reinforcing to the client. We need to be the support that the client needs to serve as a reminder to make sure that they're accounting is smooth, so financial analysis is going to be substantially easier. This is typically a service that we provide to our premium clients only. Anyone that's just compliance based accounting, really we won't focus too much on this, but any premium client, which is, you know, any contracting client or developing client that we get, is going to be retained for premium services. You know, we have to make sure that we are on top of these things, and every month we close, so we can also support with financial projections based off of the amount of burn rate of their cost of goods sold, GG&A, help them gauge their own capacity as they're looking to pick up more work or looking to develop more projects. We're consistently the guys keeping the pulse on that company's finances on every close. And if the close is clean, it should never take us more than an hour to have a thorough analysis of the client. And as you can see, most of the time people don't really care that much about accounting. They just kind of want to look at, cool, where's my net income? Hey, look, there's a couple variances here. Most high level bird's eye view owners, they're not going to sit there and care about a month over month financial analysis. That's kind of our job, to look at things, maybe pick a couple things that click out, fix them before we shoot them out to the client. If they're right, shoot them out, put a couple notes in there so that they can look at it real quickly. Yep, this makes sense, this doesn't. They may ask for a couple transaction details, or we may ask for it to make sure that the information's correct, and they'll just kind of look at the bottom line and keep rolling. But this is fundamental for us to have a good understanding, because as our clients grow, so were our engagements. And the idea is that, you know, we want to be the best construction accounting firm that exists out there. Well, besides that, we got a black screen. There's nothing else. If there's any questions on any difference between development entities and contracting entities, just go ahead and ask me, and we'll get it taken care of.